In this week's update, the noise will drive you crazy if you let it. The importance of technology leading and effective portfolio construction. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. Okay, I just want to start this morning with just some really important market perspective, because I'm getting a lot of questions obviously around the US election, which I guess is understandable. But look, the key point is that there's just so much media noise out there, and I'm sure you've got a lot of thoughts running through your head. And if you let it, all of that accumulated noise is just going to drive you crazy. And in fact, what it's going to do is prevent you to make clear thinking decisions. So it can only be a negative. There can't be anything positive about trying to understand or anticipate how the US election might play out and how that may affect the markets. It's just absolutely pointless. So I'd really encourage everybody whose thoughts are going that way to just to stop doing it, because it's absolutely counterproductive. So the questions obviously that are on a lot of people's minds, will the Democrats win? Will Trump engage in some sort of legal battle because he doesn't win? What will the market do before the election? What will the market do after the election? I mean, we're seeing just how nervous things are at the moment. When it was announced on Friday afternoon that Trump had caught the virus, then the US futures just absolutely fell over and the Australian market dropped very, very sharply. So we're going to continue to see those sort of events, I'm sure, play out many times over between now and November. But it matters absolutely not. You can't anticipate what will happen, and the reaction's completely the reaction is completely unacceptable, and it really is just a pointless exercise. The key point that I'm trying to make is that the impacts won't last, but they will be better for some stocks and they'll be far worse for others. So there is going to be stocks that are going to do quite well in the medium to longer term, and there's going to be stocks that are going to be significantly disadvantaged. So the key is, to my way of thinking, it seems such a fairly simple concept, but I think it works, is that we select stocks where it doesn't really matter who wins and how the market around the election progresses. So I want to just turn to some thoughts on portfolio construction. And I do a lot of this in Portfolio Analyst in particular, because I get a lot of questions about all sorts of different stocks, highly speculative, highly conservative. It's the full range of stocks on the market. So yes, it's okay to have stocks that have got compelling long-term fundamental reasons to grow powerfully. I think there's a position in everyone's portfolio for those kind of stocks. They may not be moving now, but the long-term fundamentals are almost so assured and so strong that the price is almost certainly going to move up at some stage over the medium to longer term. So it's okay to have some of those kind of stocks in there. And everybody has a few favourites. They have a few, specky mining stocks, or a few small stocks that they may be particularly keen on. So I think you can have a few of those, but you've got to recognise that, in a sense, they're sort of play money more than anything else. And really, you should keep those positions very modest. You certainly shouldn't have a portfolio that's got a lot of those sort of stocks where you're looking for stocks that are out of favour to turn around, or whatever it might be. But to my way of thinking, we're in the market to make money. We're here to use the assets that we've got as productively as we can. So I really struggle with the concept of buying something that you're going to put in the bottom drawer for the next 5 years. And I still get questions from people along those lines. I'm intending to buy this and sit on it for 5 years. Well, I just don't understand why you want to do that if the price may not move for several years. Isn't that a waste of opportunity, or a waste of the efficient use of capital? That's how I look at it anyway. So therefore, buying leading stocks in leading sectors because they are performing right now is a very powerful way to go about using your funds productively. And so I think a good portion of your portfolio should be in the leading stocks in the leading sectors. And I've covered this before, and I cover it all the time in my membership services. So just touching on a couple of points, and then I'll show you a few charts to illustrate. The concept of relative strength. Stocks that are outperforming the S&P or outperforming their sector, they're doing that for a reason, because the fundamentals are improving. And then on top of that, because they're outperforming, fund managers, particularly in the States, are compelled, they're forced to buy those because they can't afford periods of underperformance relative to any of the indexes. So that fund manager buying then adds further impetus to the outperformance anyway. And that's why outperformance tends to run a lot further and for a lot longer than anyone would anticipate. So why not combine all of the above? Why not have some stocks that have got powerful, virtually unstoppable fundamental trends? And we're talking 5G, artificial intelligence, smart medical devices, biochemistry, the list goes on, renewable energy. So go into those sectors that have got those virtually unstoppable fundamental trends, find the stocks that are leading that sector, and that's it. You know, investing is not a particularly hard science. It's really as simple as just getting clarity around your thoughts. Use relative strength to advantage and go with what's working now. So let me show you some examples. So this is going back to the year 1998. So right over on the left-hand side is 1998. So we're looking at 22 years of history. And what this chart is the ratio between the technology sector and the S&P 500. When the line is rising, that means that technology is outperforming the S&P index. So it's doing better than the general market. Now look at what was happening leading up to the tech wreck in 2000. Technology was absolutely killing the S&P. So the line was running up very, very strongly. Then we got the crash and we entered a secular bear market. So the secular bear market from 2000 to 2013. And during that period, the technology sector dramatically underperformed the S&P. You can see this huge crash. And then from 2002 through to 2013, it largely went sideways. So technology was not leading during a secular bear market. But look what happens when we get into a secular bull market. Technology leads almost the whole time. And yes, there was a little period here in the end of 2018. There was a few other little blips along the way where technology didn't outperform the S&P for very brief periods of time, but it very quickly regathered. And look at what's happened here. This is, let me find March. Here we go. Here is March, April, or sorry, February, March here. So here's the crash in the market. Now look at what technology stocks did relative to the S&P. I'll just tighten right in on that so you can see it more clearly. So this is the period here of the crash. And look what happened. Virtually no change. So technology stocks, if you wanted to be in safety, even during the crash, then technology stocks were the place to be. And because we're in a secular bull market, it's likely that this outperformance of technology is going to continue. Yes, there'll be tiny little steps back, but they'll be brief. So if you've got a lot of technology type stocks, then you could expect that the periods of underperformance are going to be quite brief. Let's now drill down a little bit more and let's look at some of the individual sectors. So consumer discretionary versus the S&P. Look how well this is done. You know, it did underperform a bit during the crash, but it's gone up very, very strongly throughout. So consumer discretionary stocks doing much better than the general market. So why wouldn't you find some of the strongest performers in consumer discretionary and just focus on owning them? Let's look at semiconductors. So this is a industry group within technology. Let's look at how semiconductors have gone compared to the S&P and what happened during the crash. Let's find the crash. Here it is here from the end of February to the end of March. Almost no impact at all. So semiconductors have been outperforming the S&P for a long period of time. So why wouldn't you focus on owning them? This is US software index versus the S&P. Same story. And I'll come back to that one. Shortly. So I hope that these sort of thoughts and perspective on how you actually put your portfolio together will be helpful. I think you'll end up with a far better result as a consequence. So the bottom line, and I'm sure those that watch this video regularly have heard me say this before, trade what you see and not what you think. And it's never been more important. And the big added bonus coming into and out of any corrections that we get, and we're almost certain to get more corrections in coming years, and we're going to get more episodes like we saw on Friday afternoon. But the big bonus is that the outperformers will fall less, they'll stop falling sooner, and they'll recover the fastest and set new highs the fastest. So why wouldn't you want to own the outperformers? It just really defies logic not to. And yet I still get so many questions from people that want to try and pick the bottoms in out of favour stocks that have got headwinds for as far as you can see, stocks that are way down, or stocks that are really highly speculative. It just doesn't make a lot of sense to me. So what are these sectors in the US market? And they're easier to identify in the US market. It's most industry groups within technology, and there's a lot of those. I just showed you a couple, semiconductors and software, but there are others. Consumer discretionary is outperforming. Now you could argue whether it should or it shouldn't, but the fact is that it is. So just go and find the strongest stocks in consumer discretionary. Communication services has been another extremely strong sector. And selected groups in healthcare technology in particular. So I hope that overall perspective helps you a great deal. Let's turn to the market now. American stocks, the S&P, despite the bit of toing and froing on Friday because Trump caught the virus, the S&P ended up rising 50 points, 1.5% for the week, and is still not that far off all-time highs. And so at this point in time, this can always change of course, but at this point in time, September 21 remains the low. Looks like it was the pivot point for the market. And so again, just let's trade what we see, not what we think should happen. And that's what we have at the moment. The US election, probably the worst outcome for the markets would be a clean sweep for the Democrats, with winning the Senate and the lower house, which they already have. And the reason that would be the worst outcome for markets is because then governments can do something. And whether it's Democrats or Republicans, the markets tend to be happier when governments are hamstrung, when they can't actually make decisions and enact policy, which is a bit of a sad indictment on how things work in the Western democracies these days. So a clean sweep for the Democrats will allow them to enact a number of their policies, whether you agree with them or not, and the markets probably won't like that. But as I said earlier, right at the start, the bigger picture is it doesn't really matter, and just go and find stocks where it doesn't matter even more. They're just going to shrug that off. Now, importantly, in America, the economic data continues to beat forecasts as well. So this is not a speculative bubble caused by excessive printing of money. Now, certainly that is having an impact. The liquidity is helping. But the American economy, from an economic data point of view, is actually moving along quite okay. It's not the basket case that you might expect because of the virus. We've got the next earnings season starting in around about 10 days. So that'll shed some more light on how the American economy is doing. The US dollar slipped a little bit, not a lot of change, and the 10-year yield still remains stuck around this 0.65, 0.7 mark. So let's take a quick look at the indices. Oh, and just one other thing, just coming back, perhaps putting things in the Australian context in terms of relative strength. This is a chart of Woodside. So I get questions from time to time about people that want to buy into the energy sector. So this is Woodside. Back in the year 2008, the price of Woodside peaked out around $68. Now it's down to under $17. So people who've been long-term investors in Woodside have not only foregone a great opportunity to be in stocks that have gone up, but they've also lost an awful lot of capital. And along the way, I'm sure there would have been many points where people tried to pick the bottom in Woodside. There would have been one of them here. People would have thought, okay, there's a base, it's going to go up, and I'm going to buy Woodside for the long term because it's offering me a decent dividend. Well, that was around about the low to mid 30s. And then I'm sure that that subject would have come up again here in 2016 when the price seemed to base out, went up a bit, but it's now dropped from the high 20s and we're now down into the mid-teens. So an awful lot of value has been ripped up in pursuing stocks that are just basically out of favour. And if we want to look at the ratio between, this is the ratio between the US energy sector. In fact, I'll come back to that when I do the commodities section. So let's look quickly at the S&P. There's the daily chart. Here's our September 21 low. We've bounced back up to what may be proving to be a bit of resistance at this point in time. So this was the breakout that we saw. We've now dropped back below it and we've rallied back to it. So we're just oscillating above and below the this previous peak in February. But look, hopefully you're getting the picture that trying to make decisions around the index is actually a pretty useless thing to do, to be honest. You really need to get focused on the leading sectors, the leading stocks, and not worry too much about what the index is doing. So just looking at the US dollar, so we've had a little bit of a move up, retraced back again. It's really hard to know how this is going to play out. We've got so many competing factors at the moment. So I'm really just an observer of currency. I really don't have any particular opinion. And the Australian dollar is really just moving in the inverse to what the US dollar is doing. So we ended up the week at 71.4 on the Australian dollar. So just turning to Aussie stocks, there's where the dollar finished, and I must say that the strength in iron ore is not only helping the dollar, but it's saving our economy as well. If the price of iron ore were to drop from the 120s where it is now down into the 80s, which is where some of the longer term forecasts would have it, then we're not travelling nearly as well as it would appear at the moment on the surface. Now our index lost 3% on the week. There was a big hit in the last hour on Friday because of the US futures. It was pretty unfortunate, really, that happened. Had the announcement about Trump catching the virus come just 1.5 hours later, then the Australian market would have closed and there would have been no reaction. And there probably wouldn't have been much of a reaction on Monday when we opened either, because the US futures then rebounded. So our market just got caught just at the wrong time, and particularly small caps stocks got hit very hard. There was some real panic selling in that last hour. So I think a lot of those price movements can largely be ignored. As always, my overwhelming advice is to continue to focus on themes where there are tailwinds that are virtually unstoppable. I've nominated some of those industry groups, and just find the strongest stocks within those, and continue to go with what is working. Okay, let me just check in on the just look at the Australian index. So ASX 200. So fairly emphatically down on Friday. I would imagine that we'll get some sort of reversal of that on Monday, unless there is further news. But I think the key thing here is, with markets in general for the next few months, you've just got to assume there's going to be a lot of volatility. I think if you're trying to trade short term, it's going to be very difficult. So I would just take a bit more of a conservative medium to longer term view and try and stay with the strength. Now, turning to precious metals, gold rebounded, and gold is proving to be very confusing at the moment, because we've seen gold sell off when stocks have sold off, and then we've seen gold rebound when stocks have sold off. So, the rule book seems to have been thrown out the window in terms of the normal intermarket reactions that you would expect. So we've broken down. I've been pointing to that level around 1915 for many, many weeks. We broke down. We've now rallied back to test it, and that's perfectly normal. The question is, where do we go from here? I strongly believe that we're probably going to roll back over again and go a bit lower in gold. I think that's where the odds certainly sit at the moment, because we're in a period of seasonal weakness because of buying patterns. October tends to be the weakest month of the year for precious metals. So that, plus the fact that we've rallied back to resistance and some other factors that I will get to in a minute, I think all adds up to the probability that we're going to see underperformance from the precious metals sector for the next month. I think silver stocks are particularly at risk short term because they're just more overbought on some measures than gold stocks are. So we saw let's look at silver first. So the silver price really got ahead of itself, and I understand, and there's plenty of data supporting this, that the traders using the Robinhood platform in the States really took a liking to trading silver, really piled into silver and drove the price up very, very dramatically, doing it through the ETF. And whilst we've seen some unwinding, silver's come back from around 29, we're back to about 24. My understanding is that there is still a fair degree of unwinding has yet to occur. And one of the things about the precious metals market is that it does really need to unwind that excess, because it's a market that's driven a lot by speculative money, the hot money. It floods in and it needs to basically be flooded out again until the market can find its footing and move higher. So I think silver in particular is still at risk. If we look at gold, if you look at it on a daily chart, you can see this was the key level that I'd been concerned about. We broke below it. We've rallied back to it, put in a bit of a doji candle on Friday, and I would think that the most likely direction from here, just based on probabilities, is that we probably head a little bit lower and perhaps even try and pick up the 200-day moving average. And a lot of times, that 200-day moving average does provide support for the gold price in a correction in an uptrend. So that's a theme that tends to reoccur. And if we look at GDX, so just as a bit of a proxy for what global gold stocks are doing, so we had a breakout. We've got fairly high level consolidation, but normally gold stocks don't do that. When you get a correction, they don't tend to consolidate high. They do tend to get a final washout. Again, they tend to come back to somewhere around the 200-day moving average, which is around this red line here. So I think there's still some downside in gold stocks on a global basis. Turning to other commodities, copper slipped to 295. That's a bit of a head scratcher. There was strong manufacturing data coming out of China, so that one sort of doesn't make a lot of sense, but it's only a short-term move. And it's not a currency issue either, because the US dollar was a bit lower, so I'm pretty unclear on why that was with copper. Crude oil slipped again, 39.60, and it's a sector that you just really want to avoid. And I just had a couple of charts just to show you to finish off. So looking at the energy sector as a whole, so looking at the XLF, for instance, ETF in America, which is for the energy sector, compared to, let's say, the renewable sector. Now, this is an ETF that covers solar, which is just part of renewable. And you can see, so this is the chart of the absolute share price. Look how well solar has done. We've moved from the mid-20s on the ETF, and we're now almost to 70. Look at how well solar has done in terms of outperformance compared to the energy index, and I've got that on a spread. So this is the energy index divided by the solar index. The line is tracking down very, very heavily, which indicates that the renewable energy sector is outperforming oil and gas and general energy by a very, very big margin. So I think it's just a sector that really should be avoided at this point in time. There's the spot copper chart. We've come off a little bit since since the highs around $3.10, but still tracking fairly strongly higher. And the long-term outlook for copper over the next 2, 3, 4 years does look pretty good. So wrapping it up, my final thoughts, that we're just going to be inundated on the people's opinions on the US election. I'd really strongly recommend you don't try and anticipate the outcome and how the market might react to it. History shows that the impacts on the market are unlikely to be lasting. They're unlikely to be lasting even if the Democrats do win the Senate. The market will get over it. There is likely to be a rotation within the market for a period of time. We may see some enthusiasm come out of the technology sector in general. But there are sectors within technology and there are specific stocks that are going to pretty much ignore what's happening with the US market. So just go and find those. It's almost certain Trump's not going to go peacefully. If he loses, he's probably going to challenge the postal ballot system. He's very unpredictable and markets hate uncertainty. So I think we're going to continue to see volatility. Hard to see new highs in the US market unless Trump wins. But look, we'll see. We just have to expect and accommodate volatility. Build it into your plan. You can do that. You don't have to be a victim of the volatility. You can set up for it and benefit from it if you've got your game plan clearly mapped out. It's critical, I think, these days to own shares that are going to do well regardless of who wins the election, what happens with the trade war, what central banks do, any of that. It is possible to identify sectors and shares that are just going to march on regardless. Portfolio Analyst this week is very much going to be around this whole theme, around portfolio construction, about identifying the areas that you should be focusing on. And if you've not taken the Portfolio Analyst trial for $1 for 2 weeks, then I would suggest that you'd get a lot of beneficial information out of that. That's it for this week. There's my email address for anyone that wants to contact me, and there's more information on the website. That's it for this week. Cheers.